Welcome back. Welcome back to the show. Wow. What a week we have had. What a bunch of wild stuff going on. Kevin Warsh being named as the incumbent Fed secretary to step in. That's going to be fodder for conversation for a long time. The question is, will he stay in the seat? He was a former Fed governor, particularly during the great financial crisis, brokered some big deals to some banks during that period of time. It is an interesting choice. I would say historically, his pedigree has been one that you would not look at him and think that this guy is the guy that the president would pick, because he has not been historically on the side of cutting rates, although he's been an outspoken challenger of the current FOMC and Jerome Powell specifically. I think he even published an op-ed at one point in time in either the New York Times or the Wall Street Journal. I want to say it was the Wall Street Journal. Pretty nutty, and he's a younger dude, relatively speaking, and he was obviously well, I don't want to say obviously. We're going to jump into the show today. We're going to talk a little bit about the week that we had where we cut rates. I'm getting over a bit of being sick, so I apologize if I sound a little weird. It's not the mics. So we're going to talk a little about the FOMC, the decision today. We're going to talk a little bit about some of the stuff that we're seeing, and then kind of the future of this show. One of the things that occurred to me yesterday was that we can start rolling out some of the new forecasting what's going to happen in the markets models that we've been working on building, one of which does have AI, which is the buzzword of all companies I know. Ours is actually just used to aggregate information and tell us what's going on. I'll give you guys an early sample of that, just a bit of an asterisk before we begin, that it's not 100% perfect yet. And I'm trying to find a way to make it look a little sexier than it is, but it is a good recap. All of that AI aggregated data will dump into our market overview and forecast models so that we can have AI deriving a little bit of the conclusions that we make here, so we can remove the objectivity of us in the middle of looking at stocks saying, hey, is this a good time to buy or not? One of the models, something I'm calling the forecast, is actually ready to go. And I'll share that with you guys in a little bit. We'll probably be about 20 minutes into the show before we start sharing that, just because I think it's important to lay the groundwork there. With no further ado, let's get into it. Let's go to the market status view you've come to know and love. This is our current market status. This is not a surprise. We saw a new FOMC head being named from the president in Warsh. And because of this, the markets are all taking a step back, particularly because his history has been one, and we're going to spend some time on that, where he has been highly critical of things like having press conferences and being so outspoken, like almost suggesting that he wanted the Fed to be more driven on data and analytics. Who thought? Now, if you, again, follow the show, you know that Said and I have often been critical of how much time the Fed has done speaking. The Fed presidents have been speaking a lot. These press conferences. I don't realistically think you can walk any of that back. So his position on that is all well and good, but it does seem to suggest that he's gotten, as the Fred vernacular is, more dovish in recent years and more in line with what the president wants, as opposed to what his history has shown him. That being said, the markets are defensive right now, and they are in fact hiding in safety. I'm going to switch that color back. I don't like that color very much. I don't think you would either. Let's go here to, let's see here. It's been a long time since I even had to change the color. How weird is that, right? Let's try that. There we go. Perfect. Let's try that again. There we go. All right. So we have the Dow's down, S&P down, NASDAQ, Russell, and Invesco QQQ. This gives us a mixed defensive day. We're not seeing any particular rallies in the tech sector, despite the good day that Meta had. I am going to show you some interesting analysis in that sector and some of the things that we've seen. But this is, in my mind, a large response to a couple, actually just two real material things, one of which, a third, may actually be interpreted as something independent, but it's really a result of everything else. Number one, okay, the FOMC made their decision. They decided to hold rates. That was not a surprise to anyone, okay? So that is what you're seeing here. Number two, the 10-year Treasury is staying high. You're starting to see this return to this normalcy, this curve like this. And because of that, you're not seeing mortgage rates come down. You're not seeing affordability get any better. And the president made some really interesting comments on housing and affordability. We're going to spend some time listening into that. It was interesting, his take. I thought it was a little bit in bad taste in that he suggested that people who couldn't afford a home had not worked hard enough to get one. I thought that was a bit tone deaf, but he let his thoughts out there. We're going to listen to him. So I think that the FOMC, the rate cut decision, and certainly Warsh, who's been named now, seems to put a little bit of hesitation in the market. And the natural question is, what does the volatility look like? Where's the VIX? Where's the fear? Well, this is where we're at here. This is our variant of this synthetic volatility index. We started off the week around 90 here, and we're now down to 84. It's been about as low as 85. This is about the lowest we've seen it. It is still in calm territory. You're not seeing big moves in the market. You're just seeing a bit of a hesitation and a bit of a kind of a pullback from most people who are watching the market saying, okay, look, this is a bit of a stunner. Let's see how this all plays out. You just had the Fed rate cut, and now the 10-year Treasury is continuing to stay where it's at. Now, by many Fed presidents' objective opinions, the 10-year Treasury is actually low relative historically, which suggests, if you follow mortgage rates as a proxy for that, that a 7 to 8% average mortgage rate historically is more in line with, quote, normal. And anything from the 10-year Treasury, which is allowing those rates to be lower where they're at today, call it north of 6%, almost 7, you got a, quote, historically lower than normal rate. Now, I know that's very stigmatizing for a lot of people. A lot of people are going to say, well, we just lived through 14, 15 years of artificial interest rate deflation. Mortgage rates are super low. Of the 60% of properties that have a mortgage on them in the United States, 60% of those 60% have mortgage rates below 5%. So those rates are high relative to that market. I hear you, but when you take the average historically over the extent of time, those are just facts. And that's just a valid statement, despite how ugly that may or may not feel to be the reality that we're in. I'm taking a look here, diving into the chat. What up, Nancy? Okay, so let's get into the next chart. It's the Fed liquidity chart. This is a big part of what is driving the market today, this hesitation that we're seeing from the Fed. And because of it, we're seeing a little bit of fear. And look, again, the Fed balance sheet is not exactly what I would call flush with capital right now. You're also seeing the Fed repo line and the Treasury accounts borrowing money, which pulls that net number down. We're seeing a very tight Fed system. We are in this restrictive and drained position, which is also part of the reason why a new FOMC head who would be coming in after Jerome Powell is so important. Throwing in money in the opposite direction, where it's supportive and flooding in, would have the net effect of bringing interest rates down, increasing money supply, and doing a lot of things that would seem like a prosperous economy. Of course, the natural and logical fear in doing that is if you do that and you flood the system with cash, and we're supposed to be in a non-QE, QE kind of environment where that's happening, but you can see here that is not, in fact, actually happening. If you do that, the fear is that you would have inflation rise back up again. There is something to be said, whether good or bad, that inflation may not be behaving like we have thought historically, in large part because of AI. And I'm not the only person to think that. As a matter of fact, the incoming, assuming he's confirmed, Warsh, Fed Secretary, has said that before too, that he thinks that efficiency of inflation are now different because of AI. And I think that's probably a realistic perspective. And then, granted, there's an age demographic difference between him and someone like Jerome Powell. So I would expect that to be a more, I guess, thoughtful conversation from him. He's also somebody who historically, when he's given speeches, and I don't expect anybody to know this who's watching the show. If you go back and look at Warsh earlier in what few public-facing conversations he's had, he generally does not read off of prepared statements the same way that Jerome Powell has. And Jerome Powell does it because he knows how important it is that what words that he carry can and likely will move the markets. Very similar to what we're seeing here today in the market status. You're seeing the markets are effectively hiding in safety as a result of that. So you're going to see Warsh be a little bit more ad hoc and a little bit more off the cuff and a little less prepared in statements, assuming he is confirmed and takes that position. There are some people like Logan over at Housing Wire who's made it very clear that this was the one guy he did not in a million years want and think was the right candidate for the position. I understand the sentiment, but that is what it is. Let's look at the housing sector. I think affordability here continues to be strained. You're not going to see a whole lot of movement. And what I can tell most of you watching this is that, as we've said on previous shows, the supply has come back, but the interest rate environment here, which is really driving mortgage payment burden, mortgage payment rate pressure, price to income ratio, income momentum, all these things are very strained because we've seen this huge shift in rates back to still below the historical average, 7-8%, but certainly creeping up there. And I think many people are believing that Jerome Powell will not be cutting rates again while he is there. And I think he's out, I think it was in May. I want to say it was May. So he doesn't have a lot of time left, and they don't think there's going to be a rate cut during his time. And that actually kind of aligns where you're seeing most probabilities The next Fed rate cut being approximately 61% in June, July, somewhere in that window of time. So, and I want to say it's July was the next Fed meeting, or June was it? Whatever the case, that's the next larger probability of a rate cut. So it's after Jerome Powell's term is done. Let's look at the calendar here. All right, you got core PCE index today. We got some manufacturing data on Monday. Some PMI jolts are coming up. You should know that jolts here, this bar in black on Wednesday, is one of the ones the Fed watches pretty aggressively. You have seen unemployment creep up in most recent weeks, and because of that, you've seen this continual worry that jobs have been decoupled to inflation. So these trends that we're starting to see where unemployment's rising to 4.4% as it is currently could continue in perpetuity as you see people like Amazon reduce the number of employees because of AI efficiency and other factors like that. So I think that there's something to be said for a material change in that paradigm as well. Let's do some sharing of some new stuff. And this is not something that's going to look sexy because I haven't set it up yet, so it will cover part of my face. But I do want to share a little bit of this. This is our forecast model. I'm going to pop in over here so you can see. This is our forecast model, and it's going to be kind of a new version of. Let me actually get rid of the ticker in the background there. Oh, there we go. Let's see. Well, I'll leave it there for now. This is our forecast model. This is what it's going to look like. This is going to tell you effectively whether trades allowed, option shorts elevated. I covered this on a previous show. It isn't the sexiest look right now, but you will see it as I lay it out over time, what this will be. This is looking solely at market trends, but built into that, I also have something that I'm rolling out here, and I'm gonna give you guys a quick look. This is an AI variant, and I'm gonna go over here to my control panel. I'm gonna refeed it in and give you guys a look of what this looks like here. Let me refresh the data and analytics. What this is going to do is this is going to use AI, and I know it's covering my face. Sorry. I'm doing this solely as a way to just kind of give you guys a look into what we're building. Then it'll look sexier later on. But effectively, this is going to be an AI-driven panel. And what this is going to do is it's going to go out to the market, and it's going to pull updated analysis on what we're seeing live on X, and it's going to pull that back and give us an idea of where this information is coming from, what the rhetoric is, and what that's ultimately going to look like. So here's a great example. I'm going to refresh the analysis here. So here you go. This is a good example of AI literally pulling down public sentiment on X to push to us and then give us an explanation. Silver plummeted 35% to about $75 to $79 per ounce, while gold fell 11.6% to $5,000 an ounce, what traders are calling one of the most dramatic precious metals sell-offs ever witnessed. Keep in mind, we just came from all-time highs. You have an AI comment down here below. Such an extreme precious metal volatility often signals major institutional liquidation events that can create constraint and buyers' opportunities. So all that to say, we actually do have some pretty cool stuff coming your way. And I think that a lot of this information that we're going to start aggregating, not only from the tickers and everything else that we're looking at here, we've got a ton of data coming in from the markets. We got a ton of data coming in from the St. Louis Fed. We got a ton of data coming in now with AI, and we're using Claude, just for those of you who are curious, in the background to give us intelligence that you're not seeing on other shows. And the idea is that, look, I understand it's really easy for everybody to try to mimic CNBC. I understand that it's really easy for people to try to mimic what they see on a lot of other networks, and even podcasts these days are really sensational. What we're trying to do is give you data like a hedge fund would use internally. But we would be lying to ourselves if we suggested that hedge funds aren't using AI to make some of their investment decisions. And we're going to do the same. So what we're going to do is we're going to have a market snapshot, the first chart that I showed you, a forecast, an outcome forecast, which is going to tell you just purely based on an algorithm what the market is saying. And then the next one is going to be an AI-driven public sentiment around what's out there to kind of give you a future forecast. We all know by the time it hits traditional media, it's probably too late to make any money on any type of investment. This will help us capture a little bit of that early, where you're seeing some of that narrative in the early stages of places like X, where a lot of those people are vocal, oftentimes behind anonymous accounts with no face on it, but still gives them the ability to do so. We saw X play a critical role in things like retail trading, which cannot be ignored. GameStop being a great example of that. So what we're trying to do is be pragmatic and thoughtful about how the world really works today by pushing these things through an interface that looks very similar. Think CNBC, for example. We're very, very similar in our presentation, but the overall data analytics and the interface and database behind it are very, very different. And this is not going to be a talking head type environment. It's going to be, hey, we're presenting you the data and you tell us what you think. And to that end, let's jump into some sectors. This is the housing market right now. Currently, they're showing DR Horton, Lennar, Pulte Group, Toll Brothers, and NVR. You're seeing everybody's down a little bit. I think this is in large part in response to what we're seeing in the 10-year Treasury and that same market hesitation around the new FOMC head being named is certainly part of that. The banks are going to be an interesting switch. JP Morgan, Bank of America, Wells Fargo, Goldman Sachs, Citigroup, etc. The current executive branch favors a deregulation environment. Given Warsh's historical involvement in things like bailout of large companies, think Lehman back in the day in 2008 or so. I believe it was Lehman. He was involved in one of the big ones. That being said, he's not been historically a huge fan of regulation either, which makes him an interesting choice for the president. Although his stance on rates has been a little more aggressive than we're seeing from the current executive branch. So interesting there. This is telling you credit conditions, however, more than it is anything else. I think what small changes you're seeing here are due to the rate environment. We can go over to CRE. This is a refinance risk. Again, mixed day, nothing really going on here. Again, this pulls from our market status bar. You're seeing a mixed day, no real true signals in this. Some people are up, some people are down, all commercial real estate. So I'm not really worried about what I'm seeing here. The mega caps actually surprised me a little bit. Let's take a look at that. Apple, Microsoft, Nvidia, Amazon, Alphabet, all down. And that was a bit of a surprise to me. I didn't really see that happening today. But, hey, people do weird stuff. Let's look at Meta. I think Meta is an interesting one. I'm going to generate a chart on that real quick. I'm going to pull the chart up, take a look at it. There we go. Meta Platforms down 1.32%. So everybody from the Mag 7 appears to be down. This is trading kind of near session lows. It's still doing quite well for the year. But yeah, so we're seeing a bit of a pullback, which I can't say is really concerning at this particular juncture, given some of the things that we're seeing in the market and some of the hype that we've seen. The consumer market is bouncing a little bit back from yesterday, where we saw everybody down. Walmart, Target, not yesterday, Wednesday. Walmart, Target, Costco, Home Depot, Dollar General, all back a little tiny bit. But again, no major swings. You are seeing these two outperform Walmart and Target, which could be a trend, could not be. Industrials, not seeing a huge pivot there. Nothing there. Energy, I've always been a fan of this sector. You know that. Chevron has made some comments in the media as of late about how efficient they may or may not be with the Venezuela situation there. So I think that's probably why you're seeing a small boost for them, is some of the rhetoric. Again, it highlights one of the things, behavioral economics. People make comments in the media, and it does move stock prices. Defensive capital preservation, most of these stocks are up except for NextEra Energy, which, frankly, doesn't surprise me a whole lot. But this is where the money will go if they really start to worry about the market and the stock market. If people start to feel like they're in a bubble, you'll see the money go into these stocks. You'll see these numbers continually come back green. Again, today being a mixed day with not a lot of concerns in the market, I don't really expect there to be any highlighted issues or constraint. Let's go to the Instagrams. What up, Instagram? I don't see anything you're pulling up. Really? Because I'm looking at the feed on my side of things, and I see everything. So is the audio off or something? Or let me know in the comments if it's working well, because I see it on my end of things. I'll check a couple different things on the stream on my side, and let's see here. Yeah, everything's fine on my side. Can't wait for the THSP or Black Crown hedge fund. Yeah, haven't not. Let me explain exactly what this is going to be for right now. So a hedge fund takes other people's money and invests it. As of right now, I'm not sure we're going to do that. What I want to do is give you guys the tools to see how hedge funds are making decisions. I want to show you what we're doing and what it looks like. But outside of that, I don't know we're ever going to take anybody else's money to do it. I think if anything, we can all invest independently. The idea of you aggregating funds and getting bigger returns is all well and good, but the whole point of the Higher Standard, the podcast, at least when it started, was to provide financial literacy for those who needed it and to help people grow and build. So rather than be a stock picker or make recommendations, what I'd like to be able to do is to find a way to help people feel more comfortable making investments As of right now, it's a whole hell of a lot easier. The barrier to entry in the stock market is a lot lower than it is in the housing market. I'd like to help people buy homes too. We actually have some ideas on that. I've been talking to Homestack, who's my app provider for the Black Crown Realty app. We were going to get rid of it and actually do something different. And they suggested that we come up with a higher standard podcast mobile app, which would be real estate forward. And you guys can not only directly chat with us, but have a direct interface to the higher standard there. That's actually a really interesting idea. We haven't, Side and I didn't get a chance to talk about it last night during our podcast, or 2 nights ago during our podcast recording, but that's certainly an interesting concept that we would be interested in doing. That I can wrap a lot of this into that app. But what I want to do is provide a vehicle with which to do that, and we're going to leverage AI to do that. One of the things that's interesting is, so a lot of the charts that I've pulled up that people are seeing. Oh, I think the comment on Instagram was you couldn't see the charts that are pulling up because they're too small, possibly. Then go to the horizontal platforms. X, YouTube, LinkedIn, all have it in horizontal format. It's a lot easier to read the charts if you're having trouble there. So what we're going to do is we're going to enable AI once all these things are plugged in for you guys to request information in the chat real time. And then what we'll do is if you're on our mailing list, we'll email you or text message you direct feedback live in the show vis-a-vis AI and this bot. I've been working on that on nights, but it's been kind of a secondary priority because the first priority has been rolling out the data, getting the data warehouse situated, and now implementing the first stages of AI, which went really well last night. So that's been the primary focus, and then everything else will come after that. So thank you, and we are excited too, and hopefully we can all make some money together and show you what that looks like. All right, so I want to spend some time going over some of the sensational stuff we're seeing in the media, and this comes to no surprise to anyone how wild some of the narratives have been, not only from the White House, not only from the executive branch, but most importantly from just the overall public sentiment, because everybody's got an opinion, right? We know this. Everybody's going to say, hey, I don't like this guy or that guy, but you got a new FOMC guy coming in, and it's important that we take a look at him. So let's go over to X, which has become one of my favorite sounding boards, largely because of the anonymity. But I think that there's some important conversations to have there. So let's go straight to the social view. Hopefully this works. There we go. All right. So Lance Lambert, updated year-over-year changes in the national home price according to 6 major indices. You'll find that they're very much aligned. And for those of you who can't see them, don't worry. I got you. Here we go. This is Zillow, Case-Shiller, Freddie Mac, Cotality, ICE, and FHFA, which is the Fannie Mae. You've got some pretty significant home price increases and declines in national home price year over year. And right now, you're still seeing this above this black line. This black line shows home growth, okay? Anything above that's positive, anything below it's negative. This period down below here was the great financial crisis, which you saw a massive dip. Outside of that, you haven't seen a huge amount of corrections. This is kind of your 2021 period right there. So call it your pandemic era. But effectively, we've seen a pretty healthy increase year over year in home prices historically, aside from this real estate recessionary economy. And again, it is worth noting that real estate recessions are not all recessions. Matter of fact, most recessions are not real estate recessions. I don't know what a catalyst would be to correct real estate at this particular juncture in time. And if you look at some of the things that are being said in the media by people like the president, I don't know that expecting that to be the case is also valid. Ooh, I should probably not share that. So let's see here. Let me get back to the show. And let's go back to the live. All right, so here is your Instagram live. And let's look at, I'm gonna go back over here to Instagram. Let's see if I can pull this up. I wanna get, nope, that's not it. Sorry. Let's try this one last time here, see if I can get it to go. Huh, interesting, not pulling up. Let me see if I can pull up the right link here. There's a link I wanted to share with you guys that I think is powerful on X. And let's clear this. Let's go back to the view here. All All right. Here we go. This was an interesting statement that I thought was important to share from Yahoo Finance. I'm going to pause this, make it bigger. I don't know if you guys have heard this. I thought this was a wild take, but let's play it anyway, and let's see what you think.
Existing housing, people that own their homes, we're going to keep them wealthy. We're going to keep those prices up. We're not going to destroy the value of their homes so that somebody that didn't work very hard can buy a home. We're going to make it easier to buy. We're going to get interest rates down. But I want to protect the people that for the first time in their lives feel good about themselves. They feel like that they're wealthy people. And I want them to understand it. There's so much talk about, we're going to drive housing prices down. I don't want to drive housing prices down. I want to drive housing prices up for people that own their homes. And they can be assured that's what's going to happen. And existing housing,
that's kind of wild right there. I don't know the added rhetoric about people who didn't work hard not buying a home is true. I think that's a bit disconnected and tone deaf. I do think it is incredibly difficult to buy a home when wage inflation has not kept up with home price inflation, and we are in what is arguably, if not the most unaffordable housing market in American history. People will always point to, the 80s and hyperinflation in 70s and say, hey, there were times with 12% interest rates, and yeah, I agree, but really, home ownership is more of a byproduct of environmental factors than people want to acknowledge. Home prices, certainly. Wage inflation, certainly. Interest rates, absolutely. And interest rates, to most of people's credit, do move the needle a whole lot. That's why the chart that I show you with home affordability here shows such a huge burden on the interest rate and the payment side. It's because mortgage rate pressure is the biggest impact. For every percent in mortgage rates, you're talking approximately 30% in home value that would have to change in order to get that same type of payment relief. So it is really rate driven, but we've also had a once in a lifetime opportunity with the environment that we just came through. So it's kind of worthwhile to sit back and go, okay, we just lived through one of the most economically prosperous times in American history, and we had these rates that drove up house prices to a point that people really got a lucky opportunity. I don't know that identifying people who did not buy during that opportunity as people who did not work as hard, or younger people who grew up during this tenure of time who didn't make enough money because wage inflation has not kept up, that they should be criticized like this. Now, I understand you want to keep home values high for your primary constituents, which are your voting age Americans. And I don't think that anybody wants to see their 401ks come down as a market correction. And what happened during the great financial crisis was terrible. But there needs to be a solution. And as of right now, all the solutions that have been provided, except for I think one, really suggested to me to be a further pump of home prices up. The one exception was the borrowing from your 401k, but unfortunately, most people with more money in their 401k are older Americans who already own a home. So that begs the interesting question. A 50-year mortgage is not a solution. It's just going to drive prices up. You'd have to limit it to a certain demographic or class of people, and then you have a constitutionality argument. Similarly situated people being treated differently. So I don't necessarily know that anybody has a solution for this. So not to challenge what the president's saying so much as say that we need to find a way to get hardworking Americans who are younger the opportunity to buy a home, because the single largest source of wealth for most Americans historically has been the equity appreciation in their home over time. Barring that, the fluidity and value in the markets has generally not returned the same level of wealth for most Americans because they have not invested. But this is also part of the reason why us putting together a hedge fund like model with hedge fund like analytics is really sexy, because at least maybe we can try to counteract some of that by doing a public service and providing that information, if it makes sense. So again, not for everybody, not the same, but yeah, I saw that, blows my mind. Yeah, that one blew my mind too. That was earlier with the AI stuff. Oh yeah, the AI stuff is, I was trying to beta test it, and it's not really ready for prime time, but I was just super excited that I got it to work, to be honest with you. So for those of you who watch the show, you don't know, I do all the development at nights. Usually when my wife's getting ready for bed and doing dishes and stuff like that, I'll do some here and there. And I think the proper vernacular is vibe coding. So everything you see here on the displays, the graphics, the data, the warehouse, the server, that's all been me at night, and I'm not that smart. But if you've never coded before and you're using Claude and Claude Code, and you have access to some of the data that we have access to, and the sky's the limit. I mean, it's really disgusting. Everybody's talking about this Moltbot thing, which is acting like a kind of a real life Jarvis for the first time. It's what AI was supposed to be, and I think that's probably accurate. But we've been doing that with Claude's API for a while, and it has been really, really cool to watch and see. And as a result of, frankly, all of that, what I can tell you is we've been able to do things like bring you this kind of context and everything. But I was excited to share it because I know that we're at the tip of the iceberg for what we can do. Now, aesthetically, that's my biggest challenge. I can do all the data and everything else, but making it look pretty and making it look like this, that's where it's a bit of a challenge. You guys don't get to see it, but I actually have a control panel built into the HTML side over here, which allows me to kind of dive through everything and really get into the analytics in the back end. So whenever I'm talking to you, I can watch the markets and see what's really happening, which is also kind of cool. There was some other things I wanted to get into. So let's spend some time, and let me pull this up real quick. So this is an interesting dialogue. I saw this earlier, and I'm going to share it with you here. This is again from X, but let me make sure that it's queued up for you. And here we go. Let's go into the screen view. Let's share this a little bit. I'm going to reel this back just so you guys get some narrative here.
You made reference to Bitcoin, and I thought I heard a little bit of condescension that people are buying Bitcoin and these things.
But doesn't it? Charlie Munger, this is 2 or 3 years before he died, Charlie Munger attacked Bitcoin. He called it evil, in part because it would begin to undermine the Fed's ability to manage the economy.
That's true. And I understand why he called it evil, but we've also seen wild mainstream adoption of cryptocurrency, even Jamie Dimon coming out. I think if he were here, he would say, like he said at Davos, you got to live with the world you got, right? And that's the world that we got. Bitcoin, the blockchain, cryptocurrency, it's not going away. So yeah, it could, in theory, undermine the Fed, or the Fed can get with the times and acknowledge that this is a valuable and persistent form of currency that they're going to have to get their arms around.
Or it could provide market discipline, or it could tell the world that things need to be fixed.
Bitcoin does not make you nervous.
Bitcoin does not make me nervous. I can hearken back to a dinner I had here in 2011 with someone who is another guest on your show. I won't say his name. Okay, I just did Mark Andreessen, who showed me the white paper. That was the original white paper. I wish I had understood as clearly as he did how transformative Bitcoin and this new technology would be. Bitcoin doesn't trouble me. I think of it as an important asset that can help inform policymakers when they're doing things right and wrong. It is not a substitute to the dollar. I think it can often be a very good policeman for policy.
And what he's really referring to is that it's a true market, right? There are a lot of people, myself in part one of them, who believes that government intervention in traditional capitalism has caused problems. And one of the charts that I brought up in a previous show that I will bring up again seems to suggest that has a huge impact on the cost of things, whereas Bitcoin and the blockchain is more pure in that regard. And I think that's what a lot of what Andreessen was referring to in the conversation with him and the subsequent white paper.
And if I were to speak more broadly to what did Charlie Munger and others perhaps have in mind, there is a proliferation of securities that go under all sorts of names. Many, if not most of them, are not worth what they might be being traded for.
That's right.
So what did Charlie say, and maybe his pal Warren say? There's the innovators, the imitators, and the incompetents. They're real innovators that are happening in and around that new technology. And what I would try to impart towards businesses and bankers is that the underlying technology that Mark showed me in that white paper, or tried to show me in that white paper, it's just software. It's just the newest, coolest software that will provide us an ability to do things that we could never have done before. Can the software be used for good and evil? Yes, both, like all software. Right. So I don't cast aspersions like that. if there's a final point, it's these technologies are being built here. I don't just mean on Stanford campus. I believe in the United States. And the world's most talented engineers from China and Europe and everywhere, they come to the United States even now to try to build this stuff. And my view is by building it here, that gives us an opportunity to be more productive and create something very special over the next decade.
Yep. There you go. And, well, that was the person who was just nominated to be the next chairman of the U.S. Federal Reserve, Kevin Warsh, talking about Bitcoin. So for those of you who have not heard him before, that was him. And I purposely did not tell you that was him because I think it was an interesting shift. That is not what you would ever expect someone like Jerome Powell to sound like. It's a very, very different characterization and a very different perspective. And I don't necessarily know that I don't like him. I know there are people who really don't like him. I know there's a lot of criticism. So again, this is all the rage right now. Incoming Fed Chair Kevin Warsh, number one, the youngest Fed governor in history during the 2008 financial crisis. Said the Fed waited too long to raise interest rates in 2022. Said the Fed lost credibility by overstimulating post-COVID. Said QE, quantitative easing, inflates asset bubbles and worsened inequality. That's accurate from my reading. Personally, that's what I think it is. Claims to support a rules-based Fed, not discretionary policy making. I think that's probably smart. Wants a smaller Fed balance sheet and more focus on price stability. A new era of monetary policy is ahead of us. I agree with all of that. But there are people who are very, very, very upset with him being named. And I will try to find one for you because I want to give very broad perspectives here. And I think it's important to do that because I think what really this comes down to is, look, nobody really knows. And there are people who claim that, frankly, that, let me see here, that he is not only going to be a little bit more flexible, but that he's also going to, I just saw that Professor Galloway canceled his Google or his Amazon account. I got to look into that. That might be a whole new, is there something going on with Amazon? People trying to cancel now? Is that what that is? Anyway, Logan from Housing Wire. All right, I'm going to pull him up real quick. See if I think he posted today. Maybe he was on X. Let me see if I can find it. I think it's important to share. So, x.com. Let's check out Logan. There he is. Perfect. Oh, he took it down. Look at him. Dirty, Logan. Dirty. Yeah. So he did leave a little bit up, and I'll cover that here and share it with you. But let's go into this here a little bit. There's a social screen. You won't be able to read this, so I'll read it to you. It is important to remember that Warsh likely had to compromise his previous positions to persuade Trump to choose him. This coming from a statement from the president, I am pleased to announce that I am nominating Kevin Warsh to be the chairman of the Federal Reserve Board of Governors and the Federal Reserve System. Logan is hyper critical of him. Let's see. Oh, wow. Look at all the criticisms. These are all posts criticizing Warsh. Back in 2017, I explained what a disastrous pick Kevin Warsh would be as a Fed chair. He was perhaps the worst and most wrong federal governor we've ever had, and he was there during the financial crisis and learned nothing from it. Somehow, Warsh returned. And he wrote an article, he's citing an article here, How to Be Wrong About Almost Everything and Maybe Be Fed Chair Anyway, the Kevin Warsh story. So there are some people who really don't like this guy, and let's see if we can get any answers as to why that might be. Let's see if Logan has any statements here. Warsh 2.0 is here. Okay, let's give you Logan. Let's give you the opportunity. Also, the glasses are an interesting choice, but love is still there.
I know. All of us, we all know Kevin. We're all reading the stuff that Kevin said in the past, but just kind of look at it as Kevin Warsh 2.0. Trump wouldn't give him the job unless he reaffirmed these new beliefs. And we just have to take it that that's going to be the case until Trump leaves, and then probably old Kevin comes back. But for now, for at least for this year, think of him as Kevin Warsh 2.0, and it's weird to say this, but he'll have a more dovish tone to a lot of these Fed press events.
Yeah. Criticism. This is the same video, I think. So yeah, there's lots of people who are really freaking out, and I think a lot of that has to do with well, let's go over here to CNBC. I've shown you guys how to do this before. Go over to the bond market. You go to the 10-year, and this is part of the reason they're worried, right? You've seen the 10-year continue to drive up a little bit. Here it is at 0.014, which means mortgage rates are going to continue to drive up. The long end of the curve is going to continue to push up. And people in the real estate space are going to feel the impacts of this. Now, I don't know if this materially makes a realtor or mortgage loan officer's job that much more difficult near term, but certainly it doesn't make it as easier as it would have been had rates have gone the other way and continue to go the other way. You're seeing this decoupling. So now I can pretty much guarantee you of some material things that you should all expect. Number one, don't expect rates to come down, mortgage rates to come down meaningfully, barring some event that is unforeseen at this particular juncture in time. The Fed isn't going to cut rates anyway, most likely until after Jerome Powell is out of office, and Warsh coming in is a big question mark, which is why you're seeing a lot of the hesitation in the market. Let's go back to the market status view here. Let me clear this for you real quick. And you're still seeing the markets effectively down on the day because they're hiding in safe. They're very defensive. They're going to kind of wait and see how this all plays out. And as the 10-year continues to do what it does, you got rates that are rising. And I think that that's going to make the market feel very unsettled for a prolonged period of time. I don't think you're going to see much improvement in housing prices as far as increases go. I think you'll see it come down a little bit. I think there's going to be an issue here that's going to come, frankly, to a head where you're going to continue to see housing supply rise and demand is going to continue to come down as interest rates go up. And it's a tale as old as time, right? And we've talked about this on the show. Demand without affordability is not in fact demand. And here you've got a great example of some things that are going to impact affordability even further, right? Interest rates going up can impact affordability. And that's going to continue to bring demand down, which means supply is going to continue to rise. I don't think that there's anything on the horizon that's going to change the landscape as far as affordability goes. I think, and I talked about this on previous shows, and I'm going to be very forthright with it. I think we're in a world where you've got a lot to consider with a backward-looking view and a problem in the future. And I want to be explicit on what that means. But before I do that, great show so far. I got to get back to work. Thank you for appreciate you tuning in. Thanks for the next one. And for those of you who are commenting in the chat on the other side, Daniel Ramirez, Galloway is calling for a consumer boycott, so I suspect it has to do with that. What is that boycott on? Let's see here. If you want to understand the real power and the difference between being right and being effective, stop watching protests and start watching gross domestic products. Okay, all right, I get that. I'll have to look into that a little bit more. I got a lot of respect for Galloway's perspective. I don't necessarily agree with everything he says, but I certainly I appreciate his presentation and what he's doing, and frankly, his resume and his pedigree are really second to none. So I want to look into that just because I respect the dude. All right, so housing market stuff. 14 years artificial interest rate deflation. We went from a market that moved slowly up with some spikes in between over a very, very long period of time. Okay. And this long period of time typically should be somewhere in the neighborhood of 7 to 10 years in this peak to peak, trough to trough. But for us, this last time was so prosperous that this gap was this prosperous gap here. And this is the negative gaps here. This gap actually wound up being about 15, 16 years. So that's the longest in history of prosperous times. It's reasonable to believe if you're in your early 40s or late 30s that you are a great business person. You know, I've made a ton of money. Well, it's probably been easier, and I say this probably because there's no objective answer to this. It's probably been easier for most Americans to make more money now than it ever has been in history, which is also part of the reason I think you see the rise on social media of all these people offering courses. You've got cost of living going up, all this prosperous times, inflation pushing everything up. People are making more money. You've got this K-shaped economy, of kind of the upper class and everyone else, right? And because of this K-shaped economy and everybody else, the upper echelon of wealth in the country is carrying enough of GDP, 70% of which is consumer spending, to make the economy look like it's good. So what happens over this prolonged period of time? Everybody feels like they're pretty talented, like they're pretty good because everyone's making a pretty good money, and they're ignoring the fact that, let's just say, $300,000 a year in annual salary is not as effective as it once was just a couple of years ago, and certainly not as much as it was 25 years ago. And for those of you saying, well, Chris, what are you talking about? I've got a chart that, again, highlights this that I've used on a previous show, which I think explains this very well. And I keep coming back to the chart because I think that it does say something meaningful. This is the chart here on my right. I'm going to zoom in on a little bit here. Overall inflation from 2000 to 2025 was about 92.6%. It's that black line there. Everything down here has also gone up a great deal relative to what their previous costs were. But new cars, inflation's only been 25.8%. Clothing is only up 1.5%. This is relative to overall inflation being up 92%. Now, again, not terrible because right in here, I want to say it's right there, the average hourly wage. The average hourly wage in the last 25 years is up 131.1%. That's great. 25 years, salaries on average have gone up 131%. And a lot of these things, new cars, okay? Household furnishings, clothing, cell phone services, computers, toys, TVs, those are all nice to have. I mean, you could argue cell phones are necessary, whatever. Okay. But all the places with government intervention, the necessities, hospital services, number one, up 281.4%. So yeah, if your average hourly wage went up 131%, but your hospital services went up 281%, that's going to take a much bigger bite of your pro rata share of earnings than it did historically, even with the 131% increase. College tuition, 196.7% up. This while colleges have these massive endowment funds and really don't get anywhere near the benefit they once did off of your tuition. It's just a nice to have thing for them to keep the payment in, but most of their endowments are multi-billion-dollar endowments now, and they're making a ton of money. The question of whether they should even be charging tuition at all is out there, and it's a valid one. College textbooks, 176.9%. Childcare and nursery school, 158.8% up. Medical care services, 147.0%. All above. Housing, 111.4% up. So, yeah, we have a K-shaped economy. And this is indicative in part of how that money is spent. And I would say most Americans are forced to do this. Most Americans would like to do this. And at the end of the day, you've got a net effect of less buying power. And that's a problem. That's a problem we have not really fully realized or addressed. All right, going back to the chat here for a little bit. Saeed, perhaps you prefer from negative accounts to compound accounts, THS, making your money work while you sleep or watching on the couch. Wow. Look at you getting all sassy in the comments there. So yeah, I think we've got an interesting economy ahead, and I think that there's just going to be a prolongated fix over time. I am not feeling super well today, so I'm not going to spend a whole lot of time doing the social dives. We're about 50 minutes in. I'm going to dive in here a little bit. We're going to take a little bit of a look through some of the things we've seen, but then I'm going to call the show a wrap pretty much at the hour mark here. So let's go back to a few things. Let's check the market out. Status of the market continues. Oh, it actually got a little bit of improvement here. We got a little bit of into the no clear trend mixed day. So we've seen a little bit from defensive, and I would chalk this up to the stigma of a new FOMC head is out there. People have done exactly what we've done on this show. They've looked in his background a little bit, and now they feel, okay, you know what? This dude is remains to be seen. There's some historical stuff which shows that he's probably a little more hawkish. Sounds a little more like he's going to be a little more dovish coming in for this presidency, but that is what it is. Let's look at the synthetic volatility index. We've seen really no change here. Still a pretty calm market. People are just being a little defensive / kind of hesitant. Liquidity in the markets are still in a draining position. This is actually somehow in the last 45 minutes gotten worse. I blame this on Saeed. Usually he's drawing money out of the system. Home affordability, we've covered it several times here. It continues to be strained. There's not a lot of movement on this chart, but I do like to bring it up because home affordability is an important thing to every single one of us who watches the show. The sectors remain relatively stable. I do want to go back to the home builders a little bit and see what they look like before we call the show a wrap here. And yeah, still down on the day. So I think that's largely in response to the 10-year Treasury and some of the other stuff that we're seeing. Even though it's a mixed day and we've seen some improvement in the overall status of the market, I don't think that's going to change at all as the 10-year continues to drag on to where it's at now. And really, I would ask the question, what's going to bring the 10-year down? what's going to change that? You know, and I don't really know they got an answer for that near term. I think for right now, we're going to have to see how Fed policy plays out. And all of that long backstory to get us to here. It's going to be a longer game than most people realize. There's not going to be an immediate fix. It's going to be unresolved conflict as it relates to the economy for some time. And I don't think that if you're looking for house price improvement, you're going to see that quickly. I don't think even with the supply flood in the market, you're going to see that move as quickly as people want it to be. With AI efficiency rolling out and a future that could get more speedy and efficient as far as improvements in efficiency go. We saw what happened at Amazon with the layoffs there. We've seen it historically. We've got Elon Musk coming out saying that he's going to stop production of the Model S and Model X because he's really doubling and tripling down on autonomy. Kind of a wild thing, given that that was the benchmark that built his company. I think you can say the speed with which technology will make changes is going to pick up, and those changes will impact the economy faster. Now, again, the catalyst for how this is all going to play out for you, me, and everybody else remains to be seen. So I think that we're going to continue to see all-time highs in the market. Now, this correction that we're seeing in the markets as it relates to, gold and everything else. Oh, I just realized why people couldn't see the charts. So I have the chart on the horizontal format, not in the vertical format stream. I get it. Okay. So whenever I beta test things, I always test it in horizontal, and it doesn't push to the vertical platforms unless I carry it over. So let me do that now so people can see what the AI stuff looks like. And I apologize. The light bulb just went on. You can see it here. This is what it looks like. I have to kind of lean over to the side because this isn't properly formatted yet. This is the AI card that we're working on building here. And for those of you watching on the stream, I apologize. This is why you couldn't see it. This is literally going out to X, and it's taking a pulse. And I'm going to get close to the mic. You won't be able to see me here. It's going out to X. It's taking a pulse. It's coming back, and it's giving us automatic AI feedback on what's going on in the markets. This is not ready for prime time, but basically it tracked 91 posts, 8 of which were active, and has a 29% bearish sentiment on the day. It says that we're seeing a historic crash in silver, and it gives us the AI insight. And there's obviously lots of different insights that we can pull down from what's happening at any point in time in the economy. I apologize for those of you who couldn't see that earlier. The light bulb just went on for me. I typically don't demo those things unless they're a lot more ready to go, but being as how I was excited and couldn't sleep a whole lot last night, it made a lot of sense. So until next time, everybody, I appreciate you guys tuning in. Have a wonderful weekend. I will see you all on Monday. Okay, bye.